NVIDIA conquered AI without owning a single fab. It worked, until the entire world started ordering compute at once. Now the company is worth trillions. Built on a pipeline it can't fully control. In October 2025, NVIDIA became the first company in history to cross $5 trillion in market capitalization. The milestone arrived quietly without ceremony, just a share price that kept moving higher as the quarterly revenue numbers kept arriving with the same structural logic. The world needed more compute, and NVIDIA was the only company that could deliver it at the scale and performance that mattered. Full-year revenue for fiscal 2026 reached $215.9 billion. Data center revenue alone, the segment built almost entirely on demand for AI accelerators, accounted for the overwhelming majority of that figure. The H100, the Blackwell architecture, the GB200. Each generation released faster than the one before, each reserved months in advance by customers who, in some documented cases, were explicitly begging for allocation. Larry Ellison, the founder of Oracle, said publicly in 2023 that he and Elon Musk had been begging Jensen Huang for H100s. The phrase landed in the public record and stayed there, a precise index of what NVIDIA had become. The richest people in the world, running trillion-dollar companies, waiting for chips. There is a question embedded in that image that the market has not fully priced. It is not about demand. Demand is real and growing. The question is about the physical infrastructure that makes every one of those chips possible. Infrastructure that NVIDIA does not own, does not control, and cannot replicate on its own timeline. Jensen Huang co-founded NVIDIA in 1993 at a Denny's restaurant in San Jose with Chris Malachowski and Curtis Priem. The founding bet was specific, that dedicated graphics processing would become a distinct and valuable category of computing. The PC era was accelerating. Games were demanding more visual complexity. Huang and his co-founders believed there was a market for a chip designed entirely around graphics rendering, and that a company focused exclusively on that problem could build something no general-purpose processor could match. The company nearly failed more than once in its early years. An early product line failed commercially. A subsequent architecture, NV3, launched in 1997 and helped stabilize the company. In 1999, NVIDIA coined the term GPU, Graphics Processing Unit, and the category it described began to attract the attention that had not yet arrived. But the decisions that shaped NVIDIA's long-term structure were not made in those early years of survival. They were made in the years after the company had found its footing, when the strategic question was not whether to survive but how to grow. NVIDIA chose not to build its own fabs. It would design chips and outsource fabrication entirely. The fabless model, pioneered in different forms by a handful of companies in the 1980s and 1990s. The logic was the same logic that Morris Chang had built TSMC to serve. Semiconductor fabrication was too capital-intensive, too specialized, and too rapidly evolving for a design company to manage simultaneously with the work of actually designing the chips. Splitting the functions allowed each party to do what it did best. That decision, made and remade over decades of incremental commitment, is the structural fact at the center of what NVIDIA became, and at the center of what it is now exposed to. In 2006, NVIDIA released CUDA, Compute Unified Device Architecture, a programming platform that allowed developers to use GPU hardware for general-purpose computation, not just graphics rendering. The announcement was quiet relative to what it would eventually mean. At the time, the primary audience was researchers and scientists who needed to perform large parallel computations that conventional CPU architectures handled slowly. 6 years later, in 2012, a neural network called AlexNet, trained on NVIDIA GPUs, won the ImageNet visual recognition competition by a margin so large that it restructured the research agenda of an entire field. Deep learning, which had existed as a theoretical and experimental direction for decades, suddenly had a hardware platform that made it practical at scale. The researchers who built AlexNet did not invent that platform. NVIDIA had built it for other reasons, over the preceding decade, and the deep learning community discovered that it fit their needs precisely. This is the origin of NVIDIA's AI monopoly. Not a strategic decision to pursue artificial intelligence as a market, but a technological bet on parallel computing that happened to coincide exactly with what AI training required. CUDA became the programming interface through which researchers, and eventually the entire industry, learned to build AI systems. Moving away from CUDA meant rewriting years of accumulated research code. Staying with CUDA meant staying with NVIDIA hardware. By the time the large language model era arrived, GPT-3 in 2020, GPT-4 and the commercial AI boom in 2022 and 2023, NVIDIA's market position was not merely a matter of having the best chips. It was a matter of having the only ecosystem mature enough to train and run the models that the new generation of AI required. The scale of what followed is documented precisely. Quarterly data center revenue that had been measured in the low billions became tens of billions. The H100, NVIDIA's primary AI training accelerator, sold for prices ranging from $25,000 to $40,000 per unit, depending on configuration and market conditions. Hyperscalers, Microsoft, Google, Meta, Amazon, committed hundreds of billions of dollars to infrastructure build-out centered on NVIDIA GPUs. The company's market capitalization multiplied by a factor of 10 between early 2023 and late 2025. 61% of NVIDIA's quarterly revenue, by some analyses of its concentrated customer base, came from just 4 customers. The company that had once sold graphics cards to gamers had become the singular supplier of the physical substrate on which the global AI industry ran. And it built none of the physical components that made those chips real. The H100 and Blackwell GPUs are manufactured by TSMC at advanced process nodes, 4 nanometer and below, that only TSMC can produce at volume. The logic die, the computational core of the chip, comes off TSMC's production lines in Taiwan. But the GPU as delivered to a data center is not just a logic die. It is a system in package, a complex assembly that integrates the logic die with high-bandwidth memory stacks, mounted on a substrate, connected through thousands of microscopic bonds, packaged in a process that is itself as technically demanding as the fabrication that preceded it. That packaging process, called CoWoS, chip on wafer on substrate, is also performed by TSMC. And the high-bandwidth memory stacked onto the GPU comes from a different geography and a different set of dependencies entirely. High-bandwidth memory, or HBM, is not a conventional memory chip. It is a stack of DRAM dies connected vertically through thousands of tiny through-silicon vias, a manufacturing process so complex and yield-sensitive that, as of 2025, only 2 companies in the world produce it at commercial scale: SK hynix and Samsung, both based in South Korea. SK hynix holds roughly 60% of the global HBM market. Its supply to NVIDIA and other major AI chip customers was sold out through 2026. There is no backup supplier available at the volumes the industry requires. There is no second source that NVIDIA can activate if SK hynix faces a production disruption, a geopolitical constraint, or a yield problem at scale. Research published by Epoch AI in early 2026 quantified the supply chain asymmetry with unusual clarity. The 4 largest AI chip designers, NVIDIA, Google, AMD, and Amazon, collectively consumed over 90% of global CoWoS advanced packaging capacity and over 90% of available HBM supply in 2025. They consumed only approximately 12% of advanced logic die production. The binding constraints on how many AI chips could be produced were not the wafers. They were the packaging and the memory. NVIDIA, in response to the packaging bottleneck, secured over 50% of TSMC's total advanced CoWoS capacity by early 2026. The move effectively created a hard ceiling for competitors and a corresponding concentration of NVIDIA's production dependence on a single supplier's single packaging technology, located on an island whose geopolitical situation had been the subject of the previous 2 years of documented military exercises by the People's Liberation Army. The decision that cost billions, as an analytical frame, typically describes a decision already made. In NVIDIA's case, the decision accumulates daily. Every CoWoS booking, every HBM purchase commitment, every quarterly guidance figure that assumes Taiwan remains operationally stable and South Korean fabs continue to produce without disruption. The China dimension operates on a separate axis but converges on the same structural fragility from a different direction. China was, before 2022, one of NVIDIA's largest markets. The country's hyperscalers, cloud providers, and AI research institutions were significant purchasers of NVIDIA's data center GPUs. In September 2022, the Biden administration implemented export controls that banned the sale of NVIDIA's most advanced AI chips, the A100 and the forthcoming H100, to China. The stated rationale was preventing Chinese military and intelligence use of American semiconductor technology. NVIDIA responded by engineering a China-specific product. The H20 was designed to comply with the export control thresholds: lower memory bandwidth, lower interconnect performance, enough reduction in capability to satisfy the regulatory specifications. The H20 generated an estimated $12 to $15 billion in revenue in 2024. It was a substantial business, built around a chip designed from the start to operate at reduced capability for a constrained market. In April 2025, the Trump administration informed NVIDIA that the H20 would require an export license to sell to China, effective immediately, for the indefinite future. The stated reason was that the H20's memory bandwidth and interconnect performance remained sufficient to contribute to Chinese supercomputing infrastructure. NVIDIA disclosed a $5 billion charge in the following quarterly filing: inventory, purchase commitments, and related reserves tied to H20 units that could no longer be sold as planned. The stock fell more than 6% in extended trading on the disclosure. The number was large. It was also, in the context of NVIDIA's total revenue, manageable. What was not manageable was the underlying dynamic it revealed. The U.S. government, acting on national security grounds, had the unilateral ability to close a market that had generated $12 to $15 billion in annual revenue, with a license requirement delivered on 9 days' notice and no stated end date. NVIDIA CEO Jensen Huang had, by multiple reports, personally sought to prevent the restriction, including, according to press accounts, attending a fundraising dinner with President Trump in the weeks before the decision. The restriction came anyway. What the H20 episode made legible is a risk that was always structurally present, but that the growth of recent years had kept from requiring attention. NVIDIA's business depends on 3 simultaneous conditions, all of which are outside the company's direct control. First, TSMC must continue to operate its Taiwan fabs at full capacity and deliver leading-edge logic dies and CoWoS packaging on schedule. Any disruption to Taiwan's operational stability, from military escalation, political pressure, natural disaster, or supply chain interdiction, hits NVIDIA directly and immediately because there is no alternative supplier for either function. Second, SK hynix and Samsung must continue to produce HBM at scale, with the yields and performance specifications that NVIDIA's architectures require. These fabs are in South Korea, a separate geography from Taiwan, but one with its own dependencies on global logistics, U.S.-Korean security arrangements, and the broader stability of the East Asian industrial ecosystem. Third, the U.S. government must not decide, for security or trade policy reasons, to restrict NVIDIA's access to markets that represent significant portions of its revenue, or to restrict its suppliers' access to equipment and materials that flow into the production process. All 3 conditions held through the growth years. The third one showed its limits in April 2025, generating a $5.5 billion charge in a single quarter. The first 2 have not yet been tested by a material disruption, which means their stability is documented absence of failure rather than demonstrated resilience. The financial scale of a severe disruption to this supply chain would not be contained within NVIDIA's balance sheet. It would propagate through the entire infrastructure layer of the AI economy. Microsoft, Google, Meta, and Amazon committed hundreds of billions of dollars to data center build-out in 2024 and 2025, with NVIDIA GPU delivery schedules as a critical variable in their construction and capacity timelines. A sustained disruption to NVIDIA's production, lasting months rather than weeks, would mean data centers partially constructed but unable to commission, GPU orders unfilled, AI training pipelines interrupted, and enterprise customers unable to access the compute capacity they had budgeted and contracted for. The market value exposed to that scenario is not NVIDIA's alone. The combined market capitalization of the companies whose business models depend on AI infrastructure, hyperscalers, cloud providers, AI labs, enterprise software companies integrating AI capabilities, represents tens of trillions of dollars in equity value built on assumptions about the continued and expanding availability of AI compute. Those assumptions flow through NVIDIA's supply chain. The decision that cost billions, in a disruption of that scale, would be not one decision but the accumulated architecture of a decade of rational choices that together concentrated the production of the world's most critical computing infrastructure in a chain that touches Taiwan, South Korea, the Netherlands, for ASML's EUV machines, and a U.S. export control regime that updates by executive decision with minimal advance notice. In February 2026, NVIDIA reported quarterly revenue of $39.3 billion for the final quarter of fiscal 2025, followed shortly by Q4 fiscal 2026 results of $68.1 billion, a 73% increase year-over-year. The Blackwell architecture had ramped faster than any product in the company's history. Gross margins had recovered to 75% after a temporary compression during the transition. The AI supercycle thesis, to the extent the term had meaning, was producing numbers that validated it. The production of those results ran through Hsinchu, through Cheongju, through packaging lines that NVIDIA had booked at unprecedented rates, through memory stacks assembled with yields that required years of accumulated process refinement that no new entrant could replicate quickly. Jensen Huang, in interviews and keynotes in 2025 and early 2026, described a vision of AI factories, sovereign AI infrastructure deployed by nations, enterprises, and regions around the world, all running on NVIDIA platforms. The language was ambitious and, in terms of the direction of demand, accurate. What the vision did not specify was the geography of the single industrial chain through which all of that sovereign infrastructure would, for the foreseeable future, have to flow. The earnings filings are public. The CoWoS booking disclosures are public. The H-20 export restriction notices are in NVIDIA's regulatory filings. The Epoch AI analysis of HBM and packaging concentration is documented and peer-reviewed. The military exercises around Taiwan in 2022 and 2024 were covered by every major news organization and recorded in Taiwan's Defense Ministry publications. What is not in any public document is a credible timeline for a supply chain architecture that would make the production of NVIDIA's most advanced chips resilient to the range of disruptions that the available evidence suggests are not merely theoretical. The company's CapEx goes into design, into software, into the CUDA ecosystem. The physical production, the part that can be interrupted, belongs to someone else. The market has priced the demand. It has not fully priced the distance between that demand and the geography where it gets fulfilled.